Hello, and thank you for tuning in to the Art of SBA Lending. Today I'm going to be playing for you part 2 of our roundtable discussion on the future of SBA lending. In our last conversation, we sat down with Lynn and Kevin and Javier and talked about the role of technology in our industry and how it's really just completely changing the game for everyone. And there's some lenders that have been embracing it and some have been fighting it. And in this episode, we kind of finish that conversation and then move into really what everyone's talking about right now, which is these new SOP changes. We actually filmed this episode on August 2nd, one day after the new SOP went into effect. And you can probably tell by how confused we are. Although here we are 30 days later and we're still pretty confused. So you can get our raw reactions on this whole do what you do thing and the new SOP and what this means for small business owners. And you might be surprised at what you hear, but I'll let you listen for yourself. So without further ado, let's get on with the show.
So I've been in lending for 12 years, and you guys know I'm all about speed. So I'm going to give all you BDOs out there a pro tip. One of the biggest cogs in the process is getting the borrower to send you the underwriting package. And the last items that they send are always the business plan and projections because it's the most time intensive. So they save it for last. But that delays the process. The small business owners I know, they don't want to sit in front of their computer all day. They want to go run their business. And so that's why I send them to Rapid Business Plans right out of the gate. They make it easy for entrepreneurs to tell their story in a format bankers love. They can help with the business plan, projections, and assumptions, and turn it around in as little as 4 business days. Just yesterday, I had an ITL deal come across my desk, and I sent them straight to Rapid Business Plans because that export business plan is essential to my 90% guarantee, and I want to make sure it's done right. And guess what? The cost can count towards their equity injection because I'm going to build it into the project. It's a no-brainer. Now, I have one last tip. If you don't do startups, well, now you do. Feasibility studies tell you if the borrower's business idea is going to work. And in my experience, can give the bank the added comfort needed to get to a yes. And Rapid Business Plans offers these as well. So go to rapidbusinessplans.com and set up a Get Acquainted call. I'll leave a link in the show notes below. Welcome back to part 2 of the future of SBA. Listen, so we talked a lot in part 1, and one of the things I was thinking of, which kind of like shifted my mindset, was, okay, we're remote. It's harder to train people when you are remote. And in my mind, I've been thinking, okay, well, we need a way to train people remotely or else we're going to be left with no people, to do the work of SBA lending. But now I'm realizing technology can be implemented into the process to actually make it less labor intensive. So do we really think that's going to happen right now? Like, are any of you guys at your shops working on that?
Well, I think one of the questions is the capital expense, right? So are banks, are lenders going to want to incur the capital expense that it'll cost to initiate the AI into the system and
just change it all up, right? Because you basically have 3 options. You can pay a premium for the existing talent. You can train from scratch, which no one wants to do, which is hard, and you're remote and no one's really quite figured it out. Or you can invest in technology. I mean, those are your 3 options. I feel like 90% are going with option A, pay a premium, give it to me right now. People that already know, plug and play. And that's just what it is. But there's certainly an opportunity there because the other 2 options, while harder and maybe have some more upfront cost, long-term, probably more economical.
Well, I agree with number 1. People are paying the premium. We talked about the talent pool is getting more shell. The market's getting bigger. But also the invisible hand for our industry is the SBA premiums, and they're off a good 30%. So, the labor's going up. We're at the tail end of the credit cycle, so some of the risks are going to start weighing in. Mm-hmm. So the economics are getting a little thinner, and it's something we can elaborate on there. But I do worry about the economics, but I do look into leaning into the technology.
So at LMCU, what we focused on is the latter two. So we really shy away from general labor, interaction with experienced personnel. There are a couple exceptions to people that are just great culture fits at the institution, but we're paying our current personnel more, right? Because we're rewarding them for all the training and effort they put in over the past few years. But my entire closing department was internally sourced from other departments, some with conventional loan doc prep experience, others from retail side. My majority of my lending team either came from commercial lending or even outside of banking in general, but with a small business focus mindset, right? So our side has always been there are intangibles, right? So work ethic, attitude, culture fit. Our team is a very self-motivated team. No one needs to check in on anyone from a 9 to 5 perspective. I tell them all the time, but they're working 24 hours a day, it feels like. But that team was trained with the internal philosophy and the mindset that we have, and that it pays dividends because none of the bad habits from other shops or from previous places I've been at, we don't have those. And we're actively in the middle of an integration with a new technology platform that is focused on small balance loans, right? We're doing something that we're trying to get approvals out in 48 hours for small balance loans. But that platform, we have aspirations that will be the entire SBA 7A origination platform, where there will be a digital-only piece where the borrower is just interacting with the platform, and that's for the small balance loans. And then the over 350 is what we're considering standard, is going to be lender-assisted, right? So as a BDO, the expectations are that the customer experience would be a digital one for all loans, but the lender is going to be monitoring that process and a part of that process across the entire experience chain. And that's the only way that I think it's going to be scalable, Ray, because if we're looking at option number one, there's just not enough talent, period, point blank, to fill in all the shops. So either someone's got to train them, right? So we've been taking a stab at it.
Yeah, I have, my mind's been changed probably twice over on this conversation, because now I'm realizing that first I'm like, it's never going to happen, because I look at all the people that are running the shops and I'm just like, there's no way. But then I realized Javier's doing it, and when I go do it, that's what I'm going to do. And then when, my other friends in the industry who are, I guess you could say younger, go and run shops, that's what they're going to do. So the industry will change in 10 years from now. We will be doing these things, because if you don't, you're going to be left in the dust.
My favorite expression is, if you're not at the table, you're on the menu. So if you just want to sit back, that's fine. You may have a 2, 3, 4, 5-year horizon, maybe more. But at some point, you're going to be in the dust, right? So if you're not actively thinking about this, you're not actively looking for solutions, someone will pass you by. It may not be me. Maybe it's Ray. Maybe it's someone else that has a unique value prop that we haven't even thought of. But what I do know is it will happen. I just don't know. I hope it's me. I hope I get to eat everyone's lunch. But and it's a lot of work to be done to get there. But that's our industry. Once again, we're laggards in the finance industry compared to the rest of the technology and other industries. The writing's on the wall. We're not trying to create new things. We're trying to adopt existing technologies that work in other industries, and to think that that's not going to work here is a little bit naive. We have some really great moats from a industry perspective, right? We have regulatory moats. We have capital requirement moats. But those aren't, forever, right? We can't control the regulatory moats. We just, this might be a good segue for the SOP changes. We thought that, our underwriting requirements and all our stuff, no one's going to be able to digitize that. Well, guess what? Let's do a new SOP and get rid of all those things. Now the door's open. What do we do there?
This is a fascinating discussion because we're going to have this conversation 10 years from now as well. And then, we're going to be sitting in those seats, and then, a couple young little skateboarding kids will come in, sit in our seats, and it's just going to be nuts. But I mean, I agree. I think you're winning me over there. But, the people listening to this are in it now, in it today. They're focused on the quarter and the year and next year. And that's the point of this. We want to talk about 10 years from now if you want to do this long term. And Lynn, you understand the market as well as anyone and how to be competitive in the market because you've been a successful BDO for many years. So if you're giving advice to someone who wants to remain competitive in the future, near term and long term, what do they need to do? What do they need to change?
Off the top of my head, I would say probably embrace the technology, understand it, embrace it. I'm maybe past in my career of, really getting on board with a lot of these new technology, the AI and all of that. I mean, I haven't used AI, so to hear you guys talk about that, it's really interesting to me. And I can see where it could change the industry. I think you're very right in that the old guard will move out and the new guard will come in. The younger guys that have and women who have more of the vision of what's going on in today's technology will most likely change the way SBA lending is being done. The jury's still out whether the banks will get on board with it, or will it be more of the smaller boutique shops that will integrate all of this? Because it's hard for banks to move in that direction. As I said, capital-wise, the old guard moving out and the banks, the young guard moving in. So you guys are the ones that are going to change this industry in the next 10 years. It's not going to be me, maybe Kevin.
Technology is a great tool, and I do agree, but it is a tool. I think to be around in the next 10 years, let's look back the last 10 years. But the keys, starting at the top, is the culture. Everything starts there. The culture will then, at the top of the house, build the right talent pool. They're all rowing in the right direction. You have the right go-to-market strategy. And then lastly, it's managing the risk. There's a little bit of risk concerns, but relative to the old guard, they're not around. We need to learn what they did, what they didn't do, and why they're not around, and who's coming. A lot of the commercial finance companies have gone the way of the dodo, but a lot of them are coming back. If you look at the top 100 lenders, you're starting to see surging.
Yep.
Live Oak Bank is certainly a bank, but
Yep.
they act more
Like
as
a
a
non-bank.
commercial, right?
Yeah.
Like a non-bank. We have more non-bank licenses of the 14. For 30 years, that's been the same way.
Right.
We see the SBA willing to maybe grant some more licenses. So we're going to have a lot more new entrants. The PPPs making SBA sexy again. A lot of new 750 agreements. So a lot of people trying to find their way.
I think that is what exploded the number of SBA lenders out there now is PPP.
Correct.
A lot of new players got in to do that, and then it just continued. Now, jury's still out whether they do a good job at it or not, and the risk, managing the risk is a huge part of SBA because, as you were talking about the default rates before we got on, now interest rates are rising, the economy is, whether it's going to go into recession, maybe not, whatever. But that's part of the SBA lending is to manage that risk. And you don't want to start seeing all of those defaults starting to happen and everybody going to the SBA for the guarantee. And then, what impact is that going to have?
So if you look at the lessons of PPP, right, and this is a very topical conversation given the new SOP changes. The lesson that the SBA took, at least that's what they're communicating to the industry, is that was a successful program, $1 trillion worth of between PP1, round one and round two, to the small business community nationally. And it significantly helped traditionally true small business, which are those with 10 or less employees, right? The other side of the conversation, which is what is concerning to the industry, is you also have billions of dollars of fraud that was facilitated through predominantly automated channels, right? If you look at the proportion of fraud per institution and type of institution, those that were traditional community banking or banking types did not have the level of fraud that the pure online digital platforms.
Right.
Correct.
So that is a juxtaposition that is concerning, because to especially with experience that you two bring to the table, is that what makes this program very special is that it's a bipartisan, zero subsidy program that supports small business community. If we have higher default rates, then we will either need to raise our guarantee fees to cover that, or get a subsidy from the United States government, meaning that we're going to have to use taxpayer dollars in order to facilitate our lending. And that is a big concern, because in the event of, then becomes access to capital becomes more cost prohibitive, right?
Yep.
Or scrutiny becomes even greater in the industry, greater than it is today. So what is the fallout of this? We look back historically, some people more knowledgeable than I were talking about a program that came out in the 2000s called the Bright Start program. And that was a program that was supposed to be encouraging, loosening standards, rolling everything out. Great lenders, some lenders bought in and started lending very aggressively in that space. 4 years later, new administration comes in. Guess what? Rules change. And now some of those loans, given the economic environment, higher interest rates, slower, we all know we have business cycles. Now those loans, some of those loans go bad, and those guarantees that those institutions thought they had now are being scrutinized. Well, that's not what we thought you were supposed to be. That's not what we meant when we said this. You misinterpreted. But those institutions did exactly what they were told. So is this a repeat? Are we seeing this? Well, it's very obvious a relaxing of the standards, right, on the SOP. Do what you do is the nomenclature, and some people may do it a little bit easier than others, right?
Well, that's the concern of the lenders out there is, do what you do, but if the loan goes bad, the SBA may think you didn't do it right.
Well,
So-
the trump card is the prudent lending standards.
Right.
And what you did, if they interpret it not to be prudent, you do have some repair risks. But a second component to add to that, there's mostly great things about the new SOP.
Yeah.
We should start
Oh,
with
yeah.
that. But
Definitely.
if we're at the risk, the second thing, if you look at the eligibility, the onus is mostly on the borrower, but the lender's the backstop. So we need that oversight.
Right. Well, and part of the fraud with the PPP was knowing your borrower. And that's why many of the banks only made the PPP loans to their clients, their borrowers. Because,
KYC.
because it's know your borrower. And unfortunately, the ones that were just out there doing it on the internet, just firing them out are the ones that are at risk of fraud.
And that's complicated even further. If you really look at from a legislative perspective, there are bills in the Senate House Committee, a small business subcommittee, as well as the House, that are rescinding some of these changes to the SOP.
Sure.
So we're going to have, we live in a world of the new SOP as of 2 days ago, and we don't know how long that world's going to be. And we don't know what exactly is going to change. We see some language, we understand what's proposed, but, legislatively speaking, they can all get chopped up or never passed. So, and if we get a new administration, I guarantee you there will be updates to the entire program. And that's the world we live in, right? And I think right now it's been the most challenging to, run an SBA shop. Because you live in the world of the most uncertainty that I've ever seen in my career. I don't know, Kevin, Lynn, have you seen a time, any one of those changes alone would have been the topic of conversation all year long? And I think I can point out 5 or 6.
Yeah, this was a huge change.
Massive.
Like most of you, I use outside counsel to close my SBA loans. And when you bring in outside counsel, they become a critical part of the process. So you can't just bring in a firm that dabbles in SBA. You need a firm that focuses in it. Lewis Kappas is one of those firms. Lewis Kappas is a nationwide specialty law firm with decades of SBA experience that can help lenders navigate SBA compliance in the modern landscape. Look, SBA lending is complex and riddled with gray area. You need counsel that can provide clear advice so that you, as the lender, can make an informed decision. You can't just send every deal GP. But compliance is just the baseline. Communication and customer service is also critical, and that's where Lewis Kappas shines. Their SBA team is experienced, professional, and understands not only the legal side, but that these are real-life transactions for real people. So check them out, follow them on LinkedIn, Lewis Kappas, or go to lewiskappas.com. I just want to point out that at the time we're recording this, it's August 2nd, one day after the SOP has gone into effect.
I'd like to say these are good problems to have. Let's start with the good news. SBA is the Wall Street for small business.
Mm-hmm.
The window is now open. It's open wider. More lenders can come in. They can do it quicker. They can make decisions faster, and they can deliver better and more efficiently. That's great. It's on us to be prudent lenders, though.
Mm-hmm.
Mm-hmm. So the SBA, like, if you take them at face value, and we'll just, we all appreciate what the SBA does, and I say everything respectfully, but if you take it at face value, they're making it easier for business owners to access capital. I feel like the underlying sentiment of the existing SBA community is, we don't believe you, because if we do something the way we do it and then you come and say, no, you didn't do it prudent enough, then we are going to not have a guarantee, or potentially. And so now we're going to be even more prudent and go extra measures to make sure that we've covered all our bases, which backfires, makes it now harder to get the SBA loan. Isn't that the heart of the problem here?
Yeah, you're talking about a non-zero probability risk. We don't know for sure if that's going to happen, but we know that it's not guaranteed that it's not. And historical experience has given us inclinations that there is risk there that we have not, we don't understand or have seen before. This is all uncharted territory. How is that going to reflect itself in the marketplace? Our shop is going to, especially on the underwriting components, we're not going to change what we've done in the past. And we want to be very prudent, right, in our decision making. Are we going to try to provide to our borrowers every benefit that the program has? 100%. But, I think everyone understands the SBA box is pretty big. Everyone's box is going to be a little bit smaller that fits on top of it, right? And I think what we've been talking about is that the SBA box just got even bigger. But institutionally speaking, I think we're all going to be staying in the same box because, I don't know about you, but it's very hard to get banks or credit unions to take on more undue risk, right?
Yeah, I think most of the lenders that I've talked to about these changes are basically saying we're going to just keep doing what we've done. Like the business acquisition where you can now, the seller can finance up to 3/4 of the 10% and the borrower can put in a quarter.
Oh, you can put the whole 10% in.
Well, if you structure it
100%
right.
financing.
But
Free money.
there is no lender that I've talked to that is going to do that. So,
Let me introduce you to Ray Drew.
In some situation. But Lynn,
if they have a lot of collateral to pledge.
But that's the existing pool of SBA lenders. Isn't the idea to bring in new lenders? So
New
if I'm a new bank,
So do you think that was the purpose of the changes in the SBA, was to bring in more lenders? Is that the consensus?
The one piece of just removing the 35-year moratorium on SBLCs, that alone is an invitation for new entrants.
I would say access to capital is first and foremost, but the specifics would be more for the smaller loans and for some of the minority loans.
Exactly.
Right.
The community advantage. So the argument from the administration has been that the current SBA industry has been underserving the small balance and underserved business owner, right?
Right.
The minority owned, the women owned business, the true small 10 or less employees. and that a digital or a community advantage type of lender needs to be in place to serve that underserved market. That being said, I mean, we can talk about why the industry hasn't been able to quote unquote provide that, although more than 75% of all SBA loans are under that amount. And
It's the majority.
yeah, so it's an argument that, frankly, from data perspective, it's very difficult to put together, but that's the argument, right? Now, the thing is, the fear, right, is that that may be the sentiment, but the reality is, a new SBLC is not limited to 350,000. They're playing by the same rules we are. As a matter of fact, they're playing by the new rules that, frankly, we don't know what they are.
And they don't have the experience that we have to say if the consensus in the industry is we're going to still do what you were telling us to do, but you come in as a new entrant, you don't know what that stuff was. So now you have two different worlds. You have someone taking the SBA's guidelines at face value and doing that, and then the rest of the people doing what they've been doing. No pun intended.
Yeah. So Kevin, if I may ask, you are a state chartered institution?
Correct.
Okay, so how often does the state come in to check you out?
Every 2 years, we have the Fed as well.
And the federal, okay. I'm with the credit union. The NCUA comes checks us out as well, right? Who's checking on the SBLCs? Because we have additional regulatory requirements beyond SBA requirements, right? Based on the new terminology in the SOP, is the primary regulator for these non-bank, non-federally insured institutions is the actual SBA themselves. And with I think the new budget shows a $30 million increase in their budget that's proposed, so it hasn't even been implemented. So the concern is it's loosening up the standards, but banks still have other requirements. We have deposits that we have to make sure that we're responsible for. So we, even if the SBA says go to town, we still have significant amount of oversight that we need to comply with. So it's not apples to apples there. Do what you do is great for institutions that have significant oversight from other parties. It's a little bit more concerning for the non-bank lenders. Now, we see great players. I mean, the current set of non-bank lenders that we see in the field have been doing it for years, right? And we see the quality of their lending. We're not going to know the results of any new entrants for some time. But I think the applications ended in July 31st, and I don't. From the last I heard, down the rumor here was there weren't many applications being sent in, if any. So it's very interesting how things are playing out. It might be for the next cohort next year, but it's a whole new world.
Adding on to that, we talked about credit cycles, or you have, and we talked about managing risk. And here we are with the new SOP. Lynn, not many years ago, 95% business acquisition was crazy. A lot of our volume of recent years is fueled through Business Act with a lot of goodwill. Now the SBA's opened up 97.5%. We're north of 10 years on a good credit cycle, and we're starting to see a little bit of stress. So be careful. We went from single digits at 9.5% for many years on the delinquency and default rate to up to 20% in the 08-010.
Right.
So the economics from a lender, from managing department, being on the bank board, looking at the economics. One of those $5 million loans that go bad can wipe out profits for a lot of great loan production.
Sure.
We just need to be good stewards of what's presented to us. The SBA's offers us a gift, and it's up for us to be good stewards and handle it appropriately. And it's also up for Oakland to provide the oversight on the newer entrants, the fintechs. I welcome them, but I welcome the oversight.
We always want more, to be a true capitalist, right? We want competition because it drives the best.
And we want access to capital for our business owners.
Exactly. At the end of the day, it's not about the competition concern, right? I think back to the core that you just brought up, Kevin, is we want to make sure this program's around for, it was started in 1953, right? We're going to be approaching this is our 70th year. I want to see another 70 years, right? So how do we keep that, but also adapting to the economics of our country, right? Why are we seeing more airball deals? Well, because the majority of a bigger chunk of our economy now is in intangibles, right? Services, technology. Those aren't physical assets, not in the traditional sense. We're not manufacturers like we were back in the 90s, right? So we as an industry need to evolve just as much as our economy is evolving as well, and we need to be adapting to that. So I am happy about these changes that are facilitating. And frankly, talk about this broader macroeconomic trends. The reason why we're seeing so much business acquisition is because of the silver tsunami we've been seeing over the last 5-10 years, right? There's a massive shift between the boomers, right, and the next generation, whomever is assuming those businesses.
Yeah.
And if there isn't let's be very transparent here, guys. SBA is the only product in town that can help facilitate this type of transaction from a third party consistently for, let's say, sub $6-7 million transactions. Because if you look at other middle market or PE companies, they're not. This is too small fry for them. And outside of having a ton of money, how are you going to be able to facilitate this shift in ownership, right? And we want, as a country, we need to make sure that happens smoothly, effectively, because, once again, we know the importance of small business to our community. More than 50% of GDP contribution annually, more than 50% of employment, right? And ultimately, which is, I think, our biggest competitive advantage compared in the global landscape is our entrepreneurial support and mindset in this country is what builds small business, and small business turns into big business, right?
Yeah.
Apple was in a garage, Facebook was in a dorm room, right?
Yeah, you got to start somewhere.
Yeah.
Yeah.
Nike had an SBA loan. Ben & Jerry's had an
Was it
SBA loan.
FedEx or UPS that started
There's
with
a lot of those stories.
Yes.
But does the new SOP changes, like you talk about being good stewards of the program, like do the new SOP changes make that easier or harder?
It now falls on the individual lender now, more than it ever has before.
But they opened the window, and we should be grateful for it. We just have to watch what we do.
Okay. Well, let me get specific here, because they've removed some of the stuff that is kind of crazy, like equity injection verification, for example. That's just do what you do now.
Well, so all right, if you're going to go topic by topic, so do what you do. My commercial lenders do a liquidity verification on the last statement, right? And if it's in a bank account, there's some OFAC background there, so we know it's not coming from nefarious areas, right? If it's already
right, but does all my question is does the other divisions within SBA, like Okram, for example, are they going to go do their audit now and totally throw away everything they've said in the past about what? Because that's a big one, equity injection.
Yeah. Well,
I think they plan to stay the course. What's going to happen is where we are in the credit cycle, if things get dicey, we go back to the very high default rates. They're going to question the prudent lending standard, and
Right.
I think a few people are going to be disappointed.
But to that equity question, I think logically what they would do is come in and they're going to audit, so they're auditing your SBA deals, Okram, and they're going to say, okay, well, you only showed one last bank statement. Let us see your regular
Conventional policy.
your conventional policy. How do you do that on your conventional? If you do it that same way on your conventional, according to the SOPs, you should be okay.
Okay, well, I'm
No.
a non-bank lender, so we don't have a policy.
so your policy
Well,
needs
see,
to be
that's the
pre-approved by
question.
the SBA, and you send it in, and then they're going to.
But how do you go from a hot button issue every year flying in Nagel to talk about equity injection to do what you do? I just don't get it.
I don't either.
Welcome to
No,
the club, Ray.
Well, the SBA's been flatline in the area of $25 million a year. It went up to $36 million in 22 with all the incentives. So maybe this is a way to kind of energize.
I'd rather just take the 90% guarantee, Kevin, with all due respect, and keep the SOP the same.
It may be better on both sides if we did that.
Yeah. I suspect that might be one of the changes that they will come.
The small business committee rules are focusing primarily on, I think this is a really good one I think we should talk about, is using delegated authority to refinance your own institution originated debt. I think let's be prudent, guys. Having a second party just confirm, right? Sending a GP. If you're refinancing your own debt, that just opens the doors to some, moving your risk off of your 100% risk on your balance sheet to a 75% risk, 25% risk to you, but moving it to the SBA. We need a third party, right? So that the new legislation is asking that we codify that process where it needs to go GP processing. So that's I think a good one. The one that I don't like that they're rescinding backwards as well is the affiliation components. I like the new affiliation rules, but they're proposing that we roll back to some level of control conversation. They're talking about limiting the number of SBLCs, introducing an introductory period, right, a trial. But that, the language there could be onerous to the point where there are no SBLC is going to hold. I think the proposal was 3 years of limited origination. I mean, come on.
Well, why is this happening this way? I mean, we're sitting here August 2, and they put out notices too, then a new SOP. There's a technical update that I don't know, is it in effect because it hasn't been published? And I know it's just craziness. And now they're talking about rescinding stuff. Like, why are we doing it this way?
Because it's politics, Ray.
Am I just naive? But I'm just like,
government.
This is...
Yeah, well, I mean, you have, once again, different administrations have different priorities, right? And they have their agenda that they want to promote. And, the administrations and the industries are run by people, and people have their own focus. And, there were people inside the SBA that had a very, very strong opinion that the industry was not performing to where it needed to be as far as access to capital to underserved markets, and that drastic measures needed to be taken in order to expand that. And the unfortunate part in this, historically speaking, if you want ideal, you would have a true comment period where you would have the industry really give feedback, and there was a significant amount of feedback into the new SOP. The response from the administration, SBA, from the feedback was, don't worry, we took that all into consideration. So it really hasn't been, I would say, a back and forth component between the industry and the SBA itself. Now, I think they're coming at it from a good-hearted perspective, and I think at the end of the day, we're all going to agree that most of those changes are really good. And I think some of those just need a little bit of tweaking, but I mean, it's like a pendulum, right? Where you go one way extreme, you're going to get a hard course correction to the other way, and we're probably going to lose some stuff that we would like to have.
I'd like to lead as lenders. I think we've done a poor job lending to community-advantaged loans.
Mm-hmm.
This is a public-private joint venture from the private side, which we sit on this side of the fence. We're in for the profit. The
Right.
bigger real estate secured deals with 2 years of cash flow are the best deals to put on from a risk.
Yep.
It doesn't provide access to capital to some small, very micro loans in certain target areas, and that's where the SBA is a public policy.
Yep.
So we're going to have that dynamic tension, that back and forth. To get it right, this SBA administration and what I've seen over the last 10 years has been, we've made more progress in 10 years, I think, the last 20 or 25 put together.
That is true.
We
I
have
agree
some
with you.
amazing people within the agency.
Yeah.
And a lot of them, some came from the agency, obviously. But
Right.
new blood coming in from the banking sector has really helped.
Yeah.
They have a fresh perspective. We can talk about why we haven't been serving that group, and we can talk about the economics there, right? At the end of the day, when the paperwork is the exact same for a $300,000 loan as it is for a $3 million
That's the
loan,
problem.
when you're incentivizing
cost.
BDOs to do commission-based deals, I mean, you're gonna get out what you incentivize, right?
Well, and the cost of servicing it.
Yeah,
The servicing is the same.
It's real.
So if you're gonna make a loan, make the $2 million one versus the $50,000 one because the servicing is all
And
the
that's
same.
why the SBA is reducing the because if you do what you do, right? If you have a scoring model for loans under $100,000, guess what? Now you can slap an SBA guarantee on it as well. If I may plug, one of the things I think that is really to fill in the gap. I mean, the small business community has significant amount of resources that are available that frankly most small businesses don't take advantage of. I think we as lenders, we know that, hey, a small business needs a little bit of business plan support, right? Well, let me introduce you to the SBDC, right? Great resource, or SCORE. That list is long, and the resources are even longer, right? Between, loans that we would not be doing, grants, technical assistance, legal assistance, workforce assistance, government contracting assistance, export assistance. That list of organizations, most businesses don't know. There's not one place where it's all together. So one of the things that I think as a community, and this is a personal passion project of mine, I want to highlight those organizations because we need to be partnering further with them, right? To really, talk about that whole life cycle. Banks, are a little further up on that arc, right? There is that initial piece that sometimes we dip into, but most times we don't, where it's the startup, the young, the troubled company, or the company that went through some issues, but they still have the good value proposition, good work ethic, good employees, and maybe a little bit earlier on with these nonprofits, they can get that assistance, and then we keep an eye on, right? That I think circling back to that first conversation we had, Lynn, it might not be a no, it's a not now. Let me introduce you to these groups, get to these marks, right? Keep me updated, and bam, now you graduate out of that space and into SBA, right? And so one of the things that I'm working on right now is I'm in the South Florida market predominantly now. I'm interviewing and talking to all these organizations, and I'm putting out their resources on every channel possible, whether it's YouTube or social media, as well as a centralized database on a website where a small business can sign up and just auto match with these organizations. Because in my opinion, these are being underutilized across the board, and that could help us bridge that gap. Because incentives-wise, right, these groups are focused on the mission, not the profit, right? And we, Kevin, we have families to feed, and all our employees have families to feed, and they're going to focus on what makes most money, right? And the amount of time, it's unfortunately, the truth is the amount of juice for the squeeze on a small loan sometimes is disproportionate, not only on the size, but also the amount of attention you need to provide. Because those are, my experience, end up being the most needy as far as hand-holding.
They're not as sophisticated borrowers.
Exactly. But that doesn't mean we should ignore them, because this is where we are back full circle with the SOP changes.
Well, and I like the small loan changes. I mean, I'm for that, under 500 and increasing it to 500. Okay. But, then there's some things beyond that, which is fine. I just think, like, with the world that we're in today, the information is coming out and the borrowers are seeing it at the same exact time we're seeing it. And we don't have answers.
Yep.
That's the part that compounds all this. And you started seeing that in PPP, and now you're seeing it today. And just the way it's rolled out has caused a lot of confusion because people don't know. Partial change of ownerships are coming across my desk, and people said the seller guarantees, the seller doesn't guarantee. Now the seller does guarantee. Yep. And, these are affecting people selling their businesses. Like it's having like a real world effect. So I just feel bad for them because of that.
I mean, we're going to find out soon, right? I mean, we're getting these requests, and now we're submitting. Prior to August 1st, when we would send in a comment on the new SOP, it's like, well, it's effective August 1st. So now it's just going to be open dialogue. We keep getting clarifications. This is, once again, why SBA is such a beautiful industry, because it's a tight community. Thank God we have resources that can reach out to Kevin or Lynn.
Well, that's the best thing. Lynn, thank you so much for driving down here from Orlando down to Deerfield. Kevin, appreciate you joining. Javier, coming up from Miami. The fact that we can sit at a table as fierce competitors, which obviously we are, but we're also friends, it says a lot about the industry. And it's one of the reasons I fell in love with the industry. 12 years ago when I walked into a Flagel event, and you were probably there because I was living in Orlando at the time. Yeah. And it was just like you're embraced by these people, this community. So I do think we'll get through this, and we'll definitely come out stronger on the other side. So,
amen.
Ray, I understand the frustration, but let's get back to the message. Is the SBA is a Wall Street for small business. The window's more open. It's going to be more streamlined. It's going to be more efficient. There's a few things we're working through, but we'll get through it. Yep. Here's a good opportunity for you to get out in front of all of us, to get in front of the community and just say we want to do more loans.
Yep.
We want to do it prudently, but we have now some tools at our disposal that we can be more nimble and flexible and get you the funding quicker.
Yep, that is true.
It's a net positive. I agree. And frankly, I'm an optimist. And what I do know for certain is that we have plenty of job security between all the changes and all the updates and the potential demand that this new world that we live in will create.
So even AI can't replace us at the moment?
No,
we're underwriters or closers.
No one can replace
Shout out
you,
to
Wayne.
my underwriting closing team.
Well, I think it was a great
Great.
discussion, guys. I appreciate you all for joining us today.
Thank you, Ray.
Thank you
Thank
for
you
having
for
us, Ray.
the invite.
All right, that's it for this week. Don't forget to subscribe.